Hello there, welcome back to my channel. This video, we want to look at module one. So we are going to look at the last part of module one. Remember, in the previous video, we looked at the first part of module one. So today we are going to look at the remaining part that we have on module one. So we are going to start on organization, and then we move on to management functions. So you'll see that in organization, basically, it's a group of people united for a common purpose. So when we have a group of people that are united for a common purpose, we call that an organization. And at the end of the day, that organization is run by managers. So in the form of our management, being composed by managers, uh, you'll see that we have got three groups whereby we have operating management. We also have military management and also executive management. And that is the setup that we have in terms of management. So basically, you'd see that then there is the formation of management functions so that the organization can operate well. So, a management function, basically, management functions, these are processes that help organizations achieve their goals. So, that's the description that we have in terms of management function. So, the organization is grouped by areas of specialty within different functional areas. So there we have the formation of management functions. So basically the management functions that we have got planning, organizing, controlling, and decision making. So those are the four main management functions that we have. So we are going to go through the information that we have according to this video by starting to look at the different management functions that we have, as we have four main management functions. So going on, you'd see that we are going to start on planning as a management function. So planning basically is the act of deciding how to do something, or we can also describe it as it lays the groundwork for the execution of critical tasks. So that is planning. So other planning, you'll see that we have a long term that is strategic planning. And also we have got short term that we call operating plans. So basically, that's what we have. So believe that we have that planning is subdivided into two forms, which are strategic planning, and they are usually done by the executive managers. And examples that we have in terms of strategic plans. So what is also important for you to take note under strategic plans is that they are long term. So the first that we have is these plans determining the future of the business. So anything that determines the future of the business that is not short term is under as our strategic plans. And we also have which products to produce, as we are determining which products do we have to produce, whether to buy or rent premises, whether to open or close down branches. Uh, those are some of the examples that we have in terms of long-term or strategic plans. Then we'll move on to operational planning. These are short-term planning and in terms of operational. But what you have to take note is that operational, these are plans that we engage in the day-to-day running of organizations. So they are short-term. So they don't uh, mainly look into the future. They look at what is actually supposed to happen in the near future to come. So we have examples that we have on the first one. We've got selling price for products. We've got hours of operation, where to advertise, discount policies, which suppliers to use. So those are some of the examples that we have in terms of operational as the first management function. And then we can move on to look at the second one, whereby we have organizing as the second management function. So on organizing, we are saying it involves coordinating the different resources. So basically, organizing it involves coordinating the activities of a group of people efficiently. So whenever we have the element of coordinating a group of people and we do that efficiently, it's organizing. So basically, that's what we have in terms of explanation of organizing. So it can also go on to describe the issue of coordination of different resources. Remember, examples of resources that we've got capital labor, also examples of resources. So the coordination that takes place of those resources is also organizing. So That's what we have. And also, you see that organization means that we have different departments for different functions which work together for the benefit of the business. So if we have got different departments working together to benefit the business, it's also part of organizing. So workers can then specialize in tasks which they prefer and like best. So that again leads to a contented workforce. So basically, that's what we have in terms of organizing. Then we move on to the next one, which is going to be leading. So basically, leading, you're saying this is a skill of influencing and motivating people to work together to reach the goals of the business. So basically, that's the explanation on leading. And also, we can further on describe it as guiding, directing, or influencing. So the element of guiding, directing, influencing also describes leading. So again, it's something that we can rather describe it as coming in advance of something. Whenever you come in advance of anything, you are leading. You are showing the direction on which the direction should be taken. That's leading. So that's what we have on leading. Then moving on to the next management function, which is now controlling. So on controlling, it reads, this involves comparison of actual performance with the goals planned. They look at the reasons of differences and then take action to correct them. So on controlling, we are seeing a comparison that is there between actual performance and what was supposed to be done. And whenever there's a variance, there is need for corrective action to be taken. So that is controlling. So basically, we are saying under controlling, there's the issue of monitoring variance between plans and actual performance. So that is um, controlling. So when management control, that's when a management compares actual performance with the goals planned. So they look at the reasons for differences and then take action to correct them. So with controlling measures, managers monitor results and try to get the staff to cooperate to reach our objectives. So at the end of the day, the feedback comes through various reports, both financial and other reporting ways. So basically, this is what we have in terms of controlling, which sums up the four main management functions that we have. So obviously, we now try to move on to the next aspect that we still have on module one. So moving on to the next aspect that we have, it's a decision making. So a decision making on its own, you'd see that it's not a separate management function, but it forms part of each and every management function. In other words, we are saying for you to undertake planning, leading, controlling, in all those management functions, you do decision making. So we are saying decision making is part of all the management functions. So that is what we have in terms of decision making. So at the end of the day, we are saying decision making is not really a separate management function. It forms part of all four other management functions. That is planning, organizing, leading, and controlling. So you would see that all of them, they entail decision making. So you cannot plan, you cannot organize, you cannot lead or control without taking decisions. So basically, that's what we have. So it's also important for you to know that the first step that you have to undertake in decision-making process is to clearly outline the goals or objectives of the business. So again, you'd see that for you to undertake decision-making, you have to choose between different options. So what is important in decision-making is for you to have the information that is going to lead you to a decision that you are going to take. So very important it is. So we are going to see that we have got types of information needed for decision making. So if you go down, you'd see that we are given types of information that is needed for decision making, whereby we have the first one, quantitative information, we have qualitative information, also we have summarized information, being some types of information that can be needed for you to undertake decision making. So for you to be convinced to choose a certain option, you should have information in those three forms. So what is important at this point now is to understand exactly what actually do we mean when we say quantitative information. So you see that Basically, quantitative information is information presented in the form of numbers. The numbers is the quantity form that we are talking about. So, for example, calculations using rands, that is a value of money, is a quantified set of data that you are presenting. And also, even if it's presented in the form of units, for example, kilograms, that's also quantitative information. So, that's what we have in terms of quantitative information, and then we've got also qualitative information. So qualitative information, this is information which cannot be counted. We are talking about, let's talk about the motivation of the workforce of the labor. The workers, how are they motivated? We cannot quantify the motivation that the labor has. So that is what we call qualitative information. So qualitative information examples that we can talk about alternatives available. Uh, yeah, economic indicators also is part of qualitative information. Then lastly, we have got summarized information, whereby summarized information, we are saying this is the usual information that is valuable to managers to pinpoint problem areas where the organization is not working as well as it should be. So we have examples of information presented in the form of financial statements. Financial statements, we're talking about the income statements, we're talking about the balance sheets. It's information that has been summarized. We have got a lot of accounting information that are leading us to prepare an income statement. So, but when it's not presented in the income statement form, it's now summarized. So, a very important information in terms of decision making, especially on the part of the management, because it gives a general overview in terms of how the organization is performing. So basically, that's what we call summarized information. So on that part now, we can move on to organogram. We can call it an organogram, and we can also call it an organizational chart. So that's our next aspect that we want to look at. So we are here where we've got our organogram, or we can call it an organizational chart. So basically, this is a diagram that shows the structure of an organization and its relationship. So it comes as a diagram that shows the structure of an organization and its relationship. And obviously, in that diagram, that's where we've got the outline in terms of the levels of authority that we have in that organization. So it shows the internal structure. So basically, that's what we have in terms of organization. And also, it shows the relationship and reporting hierarchy. Who should you report to? Who reports to you is shown on the organogram. So you see that it is very important in the operations of the business. So thereby, it helps to clarify employees' roles and responsibilities. Also, you can be able to deduce your roles and responsibilities by mere looking at the organizational chart. So believe that we are given that departments normally present at a manufacturing business are as follows. So departments that are normally presented at a manufacturing business are as follows. So we are given different departments that we have there in terms of in manufacturing business, for example, we have got the production department, we have the financial department, marketing department, human resources department, and research department. So basically, that's what we have. Then at the end of the day, we see that for all these departments to work properly, for all these departments to work properly, there should be communication that should take place within that organization. So basically, these departments are coming in because in the organogram or organizational chart, we see that there is um, an outline in terms of all the departments that we have in that organization will be shown on the organogram, and also the direction of authority will be indicated on that organogram. So that's why we are having these departments coming in. So we are saying communication is important to facilitate coordination between departments through the following ways. So why do we need communication in the organization? So basically, it's important to facilitate coordination between departments, but it's through the following ways, whereby the first one we are saying submission of policies and instructions to subordinates, discussion of problems, making formal and informal contacts, transmitting reports, and many next, we have got an example of an organizational chart that we can see. This is just a general example that we have of organizational chart, which we are going to try to go through, whereby we have this is though it's not actually showing the names of the levels that we have there, but I'm going to try to make it clear. So on the top there, you would see that we have got the board of directors. That is here. That is here. It's indicating the board of directors. And then beneath that board of directors, mainly it consists of shareholders, or the CEO. So very important. Then from the CEO, we are going to have various departments, whereby we have got here, we've got the production manager. And then next we have got the financial manager. Go next, we have got the personnel or human resources manager. Then lastly, we have got the research and development manager. Then from the financial manager, we are having two subsections that are emanating from the financial manager, whereby we have management accountant on this part, and then we've got the financial accountant on this part. Then moving on down, you see that this arrow now is coming from the production manager. And then from the production manager, we've got different managers that are emanating from the production manager, whereby we have on this part, that's where we've got a manager distribution that is under the warehousing. And then next, we have the manager for line assembly. Then next, we have got the manager for spray painting. Then next, we have got the manager for quality control. Then lastly, we've got the manager for maintenance. So basically, this is the bottom part that we have. So this is a typical example that we have of an organizational chart. So obviously, we now need to evaluate the organizational chart. So we are going to see that the organizational chart, we can deduce advantages and disadvantages from the use of organizational chart. So what advantage can we deduce, or benefit can we deduce from the use of organizational chart in the running of business or organization? So the first advantage is that it shows clear reporting structures. So it becomes clear to everyone that is working in that organization in terms of the line of reporting. So it doesn't cause confusion. Then the other advantage that we can deduce is that it helps new employees. If you've got new employees that are starting work in that organization, they can easily refer to the organizational chart so that they can know who to report to and who reports to you. Very important to know your position. And then it also makes planning easier when there's an organizational chart, because we know where to direct resources. Even if we are trying to do our budgeting, we can easily do that. That's our advantages. Then we can also deduce disadvantages or costs of using the organizational chart, whereby we are saying it doesn't show informal channels. Remember, the organizational chart only shows formal channels, but we also have informal channels that are very influential to the operations of the business. They are not shown by the organizational chart. Then it also gives a maintenance headache. Whenever there are changes that are taking place in that business organization, they need to be changed. So that organizational chart needs to be maintained from time to time. So that's why we are saying it causes a maintenance headache. So we have to quickly update it so that it doesn't cause confusion. So basically, this is what we have in terms of on the part of evaluation of the use of organizational chart. So we can try to move on to the next concept. So on the next aspect, we are going to look at cost classification, whereby we have a definition that we have for costs, that is, it is the sacrifice of resources measured in monetary terms to obtain goods or services. So this is the basic explanation that we have in terms of cost. And then we have methods of collecting costs. Methods of collecting costs. So we are saying when we're talking about methods of collecting costs, we are saying how do we allocate costs at an organization or business? We can allocate costs according to functions. As we measure the costs, we measure them according to our functions. So we are going to see that we have got different functions that we can have in the organization. For example, we can talk about the production function. We can talk about the administration function and marketing or sales function. So all those functions, we have got costs that are specifically for production function, for example, and specifically for administrative function. So that's how we are indicating them as methods of collecting costs. So if they are collected according to different functions. That's the first aspect on function. Then they can also be collected according to different elements. So on different elements, we are talking about, for example, direct material cost as an element, direct labor cost as an element, and manufacturing overhead cost as an element. So cost can be allocated to direct material only, and can be allocated to direct labor and the manufacturing overhead. So that's how we are explaining it from the point of view of elements. For example, we are talking about the direct material cost, and this is the cost of the material which is inherent part of the finished product. You can visually see it in the finished product, for example, the wood in the furniture. So those are costs that are specifically for direct material costs. So that's how we allocate our cost. Then moving on from elements, we also have costs to different products, that is on product basis, and also department basis, income basis, and also we have got a volume basis. So that's how our costs are collected. So moving on to the next aspect that we have, we also have, where we can talk about primary or prime cost. So basically, these are just when it's primary, they include total direct material and total direct labor cost. Equal plus direct labor gives you the prime cost or the primary cost. And then we move on to the next one, which is going to be the conversion cost. So conversion cost, we are saying this is the cost of converting or transforming the raw material into finished products. It therefore includes the direct labor and all is excluded. Very important for you to take note that the direct material cost is excluded, but it takes into account direct labor in manufacturing overheads. That is the conversion cost. Then we've got cost systems. So these are methods used by businesses to collect, process, and evaluate all the information in connection with the cost of a product or service. So the purpose of the cost system is to provide information about the cost incurred, methods of collecting, methods of recording and controlling stock are as follows. So our cost systems, we have got two many methods that we use, whereby we talk about the perpetual or continuous system, and we also have the periodic system. So the difference between the two is how do they measure the costs. On perpetual, we are saying the measurement is continuous. At any time during the financial period, we can have the cost of inventory, for example. We can have the cost of sales being presented at any point in time. But when we're talking about periodic now, it's presented after a certain period, mainly at the end of the financial period. When we're talking about inventory, evaluation of inventory, the cost of that inventory can only be valued at the end of the financial period when the physical stock taking is undertaken. So basically, these are the differences that we have in terms of perpetual and periodic. So under perpetual, we are saying it keeps tracks or it keeps track of inventory balances continuously with updates automatically whenever a product is received. That is other perpetual. Then other periodic, we are saying this is when inventory and cost of goods sold are calculated at the end of the financial period. So we very important for us to take note of the difference between the two, that is perpetual and periodic. So that's what we have on that part. And obviously, we still have certain concepts that we still need to look at. So moving on to the next aspect, which is on costs, whereby we are looking at different costs that we can have. We can have unit costs, fixed costs, variable costs. Those are the main forms of costs that we have. So when you talk about unit cost, basically, it's simply the cost of one unit produced. So basically, we are saying to find the unit cost, we say the total production cost divided by the number of units produced. Then we get the unit cost. So basically, that's what we have. So the reasons why we calculate this unit cost is to reach, for example, to reach a selling price after markup. So when we have identified the unit cost, we cannot be able to find the price, to set the price by just putting a markup on top of that unit cost, and then we can see the price per unit. So basically, that's what we have. So also, why we calculate the unit cost is for management decisions. For example, bringing a new product would need us to know the unit cost so that we can be able to see if it's viable to bring that new product, and also to calculate the value of unsold stock. which is our finished goods, or the valuation, obviously, of our finished goods or our inventory. We need to calculate the unit cost. So basically, that's what we have in terms of unit cost. Then next we've got fixed cost. So fixed cost, basically, we are saying that these are costs that stay the same, irrespective of the level of production that we have. They still the same, irrespective of the number of units produced. So the fixed cost per unit will decrease. So see that when we calculate fixed costs per unit now, as we are saying, fixed cost is not changing. For example, we are saying we have got a total of fixed costs of 1,000, and we only produced 2 units. So you're going to see that there, the unit cost there is going to be 500, but it's now 5. So they are now saying 1,000 over 5 units. And is decreasing. So we are saying as the level of production increases, the unit costs, the unit fixed costs the fixed cost per unit will decrease. So basically, we are saying irrespective of the number of units produced, the fixed cost remains the same. So at the end of the day, the conclusion that we give is that the fixed cost per unit will decrease if the volume of production increase. And the opposite is true. So basically, that's what we in terms of fixed cost. However, we are now going to look at variable cost. Variable cost now changes with the level of production. They vary directly with the level of production. As the level of production increases, variable cost will increase. If the level of production decreases, variable cost will decrease, which makes it possible that at 0 units produced, variable cost will be 0. Very important to take note. But on fixed costs, when we produce 0 units, fixed cost remains the same. As we produce 1,000, just the same. So that's the difference. So we are saying total variable cost changes in direct proportion to the change in the level of production. The variable cost per unit, on the other hand, is the same. So we are saying the variable cost per unit should be the same. And in an example is the material cost for the production of the product. For example, the material used for 1 unit costs 550. So we are saying if we say total cost 800 units are divided by 100, the variable cost per unit that you get is equal to the variable cost that you calculate, the variable cost per unit that you calculate at 500 units. So basically, that's what it means, that the variable cost per unit remains the same. Not the total variable cost, but the variable cost per unit remains the same. Then we've got other cost terms that we can also take into account. We have got what we call period costs, whereby period costs are not related to a specific product, but rather to time, such as a monthly salary. It's a period cost. It's paid after a period. So it's not related to any specific product. That's a period cost. And we've got opportunity cost. Opportunity cost basically is the cost of the best alternative for goal. You are given 2 options, A and B, and you choose A, you don't choose B. So the one that you did not choose, that is the B, the value of B becomes the opportunity cost. Then I will also have avoidable costs and unavoidable costs. We also have the sunk costs, also another cost, and also controllable and non-controllable costs, and also we have got relevant costs. So those are some of the forms of costs that we have. So basically, this sums up our module 1. And thank you for listening. And let's stay tuned for module 2 to come as we move with our cost and management accounting N5 textbook. As for this video, I'm signing out. Let's meet again in the next one.